Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026 February 2nd, and today's theme is, when everyone runs to safety, sometimes the safety trips over its own shoelaces.
I love when markets do that. Like, I'm panicking responsibly. Then gold face plants, Bitcoin slides, and I'm stress refreshing my brokerage like it's a fitness app.
We'll hit 4 stories fast: Warsh-to-Fed speculation and the dollar, the precious metals slump, Bitcoin down near the mid-70Ks, and Oracle's headline plan to raise up to $50 billion for AI infrastructure, plus what a normal investor can actually do this week.
Actionable steps, please. My current plan is stare at charts until they apologize.
Story 1. Markets are weighing the implications of Kevin Warsh being nominated as the next Fed chair, and the US dollar is clinging to gains. The quick translation is, traders are pricing a Fed that could be less tolerant of inflation and more willing to keep policy tight.
So the market heard new chair and went, cool, let's all become cash goblins? Because the dollar's been walking around like it pays rent.
Basically, finance behind it, think of the Fed as the thermostat for the economy. If traders think the new thermostat runs colder, they expect higher real rates. That tends to support the dollar, pressure risk assets, and make future profits, like growth stocks, less valuable today.
So it's like my landlord raising the rent. Suddenly, my fund budget gets repriced, and I'm eating noodles, financially and emotionally.
Why it matters for normal people. A firmer dollar can cool import prices, but tighter rate expectations can keep borrowing costs stubborn. Mortgages, auto loans, business credit lines. For investors, it's a reminder to match your portfolio risk to your time horizon, not your mood.
My mood says sell everything, but my time horizon says please stop being dramatic. What's the move? Hide in bonds?
Not a one-size answer, but here's the practical checklist. If you need cash within 12 months, prioritize liquidity, T-bills, or high-quality cash equivalents. If you're long-term, consider rebalancing instead of reacting. And if you're rate-sensitive, like heavy tech exposure, know what you own and why.
Okay, but explain the part where gold, the emotional support metal, also got wrecked. Isn't that the one asset that's supposed to whisper, I got you, bestie?
Story 2. Precious metals sold off hard, then tried to stabilize. One report framed it as traders reassessing an unwind of crowded bets, meaning too many investors were on the same side of the boat after a big rally.
Crowded trade is when everyone shows up to the same brunch spot, and then the fire alarm goes off and you're all stuck in the same doorway, right?
Exactly. Finance behind it. When positioning is crowded, a small push, like a stronger dollar, higher real yields, or margin changes can force selling. People sell what they can, not what they want. That's how safe havens can drop during a liquidity scramble.
So gold didn't betray me. Gold got margin called. That is oddly comforting and also terrifying.
Why it matters. If you hold gold or commodity ETFs as a hedge, remember hedges can be volatile over short windows. The hedge is about long-run correlation and tail scenarios, not daily serenity. Keep position sizes realistic and avoid leverage in assets that can gap.
Speaking of gapping, Bitcoin. I saw a line about it hitting around $74,541. That's not digital gold. That's digital emotional damage.
Crypto extended a sell-off, with Bitcoin reported around $74,541, about a 40% drawdown from a prior peak above $126,000, per the same coverage. The simple version, when risk appetite fades and leverage is high, crypto tends to be the first thing people sell.
So it's like a party where everyone brought fireworks, and then someone yelled fire, and the fireworks were also the exits.
Good analogy. Why it matters for normal people. If you're a long-term holder, this is a reminder to size crypto like a speculative sleeve, not a retirement plan. If you're not in crypto, the spillover matters. Risk-off days can tighten financial conditions and pressure growth stocks too.
Okay, cleanse the palate with something wholesome. Like a company casually saying, we might raise $50 billion. Oracle did that, right? That's not fundraising. That's summoning.
Story 4. Oracle popped and then wobbled as investors digested a plan tied to raising up to $50 billion, framed around AI infrastructure build-out. The finance behind it is simple. Big capex stories depend on the cost of money. If rates feel higher for longer, funding huge builds gets more expensive.
So Wall Street hears AI servers and cheers, then hears we need financing and suddenly asks for an itemized receipt.
Exactly. Wrap up. Today's common thread is pricing of risk. A more hawkish Fed narrative supports the dollar, can hit crowded trades like metals, and usually squeezes speculative assets like crypto. Your action steps? Keep an emergency cash buffer, rebalance on a schedule, and don't confuse volatility with a thesis change.
And if your thesis is, I hate stress, maybe don't hold 3 leveraged things that can all implode before lunch. Ask me how I know. Actually, don't.
If you want more of this, clear structure, fewer vibes, subscribe and drop a comment with what you're watching this week. Dollar strength, gold support levels, or Bitcoin's next stabilization zone. We'll be back tomorrow on BD Daily Finance News Podcast.
And remember, the market doesn't hate you personally. It hates everyone equally. See you next time.